Hello and welcome to our channel. Today, we are going to talk about one of the most catastrophic events in American history, the stock market crash of 1929. It is a story of greed, speculation, and overconfidence that led to a devastating economic downturn that left millions of people jobless and homeless. So, let's dive into the details and find out what happened during that fateful year. Overview of the stock market in the 1920s. The stock market in the 1920s saw a period of rapid growth and prosperity. This period, known as the Roaring Twenties, was characterized by a significant increase in consumer spending, production, and overall economic activity. The stock market reflected this growth, with the major indices, such as the Dow Jones Industrial Average, experiencing significant gains. During this time, many people saw the stock market as a way to get rich quickly and invested heavily in stocks, leading to speculation and overvaluation. Despite these warning signs, the stock market continued to rise, reaching new heights in the late 1920s. However, this period of growth was short-lived, as the stock market crash of 1929 marked the beginning of the Great Depression and brought an end to the prosperity of the Roaring Twenties. Next is Roaring Twenties. To understand the context of the stock market crash, we need to look back at the period preceding it. The 1920s were marked by a booming economy, rapid industrialization, and a wave of new technologies that changed the way people lived and worked. The era was also known as the Roaring Twenties, where people indulged in music, dance, fashion, and entertainment. The Wall Street, which is the heart of the American financial system, was thriving with investors who were eager to make money from the stock market. Next topic is the speculation game. As the economy grew, more and more people were attracted to the stock market. They believed that investing in stocks was a surefire way to get rich quickly. However, the problem was that many of these investors were speculators who had no idea about the companies they were investing in. They were just following the herd mentality, buying and selling stocks based on rumors and hearsay. The stock prices were skyrocketing, and the investors were getting richer and richer. Next topic is the Black Thursday. However, this overconfidence was short-lived. On 24th October 1929, a day known as Black Thursday, the stock prices fell sharply and panic set in. The investors who had borrowed money to buy stocks were forced to sell their holdings to cover their losses. This created a domino effect, where more and more investors started selling their stocks, which led to a massive crash in the stock market. The Dow Jones Industrial Average, which is an index of 30 large American companies, fell by 11% on that day, wiping out billions of dollars of investors' wealth. Aftermath. The stock market crash of 1929 was just the beginning of a prolonged economic depression that lasted for almost a decade. The unemployment rate soared to 25%, and many businesses shut down. The banks, which had lent money to the investors, suffered huge losses and went bankrupt. The government, which had relied on the tax revenue from the thriving economy, was unable to fund its programs, and the country plunged into a deep recession. Conclusion. In conclusion, the stock market crash of 1929 was a stark reminder of the dangers of speculation and overconfidence. It showed how the greed of a few individuals can have a devastating impact on the entire economy. However, it also taught us some valuable lessons, such as the need for regulation and oversight in the financial system and the importance of diversifying investments. Today, the stock market has evolved into a more sophisticated and regulated system, but the memory of the 1929 crash remains as a cautionary tale for generations to come. Thank you for watching, and I will see you in the next video.